Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is January 22nd, 2026. And today on our call, we have back the CEO, Jeff Swainson from Simply Solventless Concentrates. Simply Solventless trades on the TSX Venture Exchange under the symbol HASH or HASH. The company is currently trading at 16 cents with about 115 or 16 million shares outstanding, or about an $18.5 million market cap. I'd now like to hand it over to Paul Andriola.
Hey, thanks, Trevor. Jeff, good to have you back. As usual, you've been a busy guy, lots of stuff on the go. Even we're so kind as to put a press release out today before our interview. So no shortage of stuff to talk about. So why don't we dive in? We'll get to an update here very quickly and talk about some of the news, but refresh everybody's memory what Simply Solventless is really all about.
Yeah, for sure. And thanks again for having me, Paul. Of course, I always enjoy coming here and always appreciate the support from you and Trevor and your subscribers. And so ultimately, Simply Solventless Concentrates is a vertically integrated to the point of from cultivation to distribution of cannabis products. And so we have suites of cannabis products all the way from solventless concentrates, which are very high-end premium connoisseur type products, all the way to large volume, ultra high potency liquid diamonds and concentrates and vapes and infused pre-rolls. And so over the last 2 years, we've grown substantially. We've completed 4 acquisitions from everything from branding houses all the way to 3 different licensed producers. And today, of course, we announced the acquisition of a small branding house called Uncommon Cannabis. But really, we're in a period of strong growth. We've expanded our revenue significantly, and we just continue to make progress.
Perfect. A little slow there on the button here. Why don't we talk about, so when we first met you a couple of years ago, you guys had just gone public. Like so many cannabis companies, you sort of struggled to get capital. You've come a long way since then. And maybe talk about kind of where you were and where you are now in terms of revenue. And you mentioned the acquisitions. Obviously, more importantly, what's going to happen going forward. But let's talk through some of the numbers.
You bet. So ultimately, we participate in the B2B and CPG markets in Canada. We're relatively balanced between those 2 markets. Of course, the B2B market doesn't have excise tax. And some key stats here on the left and the middle. So of course, our ticker symbol is HASH. We have 4 facilities, about 180 staff across Canada in 3 different provinces. We have about $60.3 million of total assets, 31.9 million of equity, 19.8 million working capital, and we're at about a 36 million annualized revenue run rate based on Q3 2025 annualized, about 4.2 million annualized EBITDA from Q3 2025. And as you guys noted, we're at about an 18.5 million market cap. If you look just to the right, of course, that's the acquisitions that we've completed. So we've done 4 acquisitions in 24 months prior to Uncommon. The total consideration paid for those is about 13.5 million. So we've done, a couple of financings along the way. On average, we've paid about 0.5 times revenue or 2.0 times adjusted EBITDA. And so what it's manifested in is really strong growth. I mean, back in 2023, so the year before we went public on December 18th, 2023, we had 7 million revenue for the year. Now, of course, we're at about the 36 million level, if you can see in the bottom left there. And then, what we're really excited about right now, one of the primary components of our business plan is, of course, the Humble Retrofit. The Humble Retrofit is set to double cannabis production out of our Humble facility in Winnipeg, Manitoba. It's a 98,000 square foot indoor cultivation facility. And with a 50% CPG, 50% B2B mix, we anticipate adding about 22.5 million gross revenue. So pro forma retrofit, we're about the 58.5 million level. So all the lights have been ordered, which is the primary component of the retrofit, and preliminary schedule is, the first substantial batch of lights is going to land in March, and then we'll begin the retrofit each time we do a harvest. I'll get more into that in detail in one of the later slides. And then in terms of EBITDA, of course, the retrofit is substantial because the fixed costs are the same as pre-retrofit. So we're not adding any, we're building within the same walls. We're just making the equipment better, retrofitting the equipment. So our floor plate's the same, and it's relatively the same number of staff, other than adding about 3 to 5 trimming staff, post-harvest trimming staff for the additional capacity. And so because of that, it's very torquey in terms of EBITDA and how the additional revenue impacts the bottom line. And so in the base case, we're anticipating about 10 million incremental EBITDA, so 14.2 million pro forma. And overall, how that translates for us is right now we're, if you look at the comps there, we're actually pretty much in line on the lower end of our peer group in valuations at 5.5 times. But pro forma, if you look to the right there, it really demonstrates that where we're valued today is not reflecting how we look at the Humble retrofit.
And Jeff, okay, let's start talking about the Humble retrofit a little bit more. And we had the opportunity to come and visit you guys. We thought it was a very, very impressive facility. The retrofit itself, how long do you think it's going to take before you see substantial, sort of results coming out of there? And what more do you need to do on a financial side as well?
Yeah, so when the lights start to arrive, as I mentioned, we'll start retrofitting each harvest that comes down block by block. We have blocks of about 16 to 17 grow pods in each block. And so that'll start in about March 22nd, roughly. Of course, this is, subject to change, but that's the schedule that we're operating under. And then every harvest that comes down from then will be retrofit. Every harvest that comes down will be retrofitted. And then so essentially, under our crop cycles and our crop schedules, we would have the first retrofit production from these lights that are coming in by the end of May. And from that point forward, all harvests would be retrofit harvests. So we'll be, if you want to add some cushion, by H2 2026 or early Q3 2026 will be 100% retrofit volumes.
Mm-hmm. Gotcha. And what do you still need to do sort of on the finance side? You said the lights are the most important piece and probably the most costly, but what else needs to be done before you can check off that everything is ready to go?
Yeah, and so the lights themselves are about $1.3 million. But we are working with Efficiency Manitoba. They are doing a rebate program on efficiency, essentially. And so if you're saving wattage per room, which we are, our wattage is, even though yield is expected to double, as you can see in the chart there, the wattage is much, much less. So we're anticipating to get 100% of the capital cost of the lights back in rebates. So basically the lights will be free, and it's just a timing issue. So we've already ordered the lights. We've negotiated with the vendor favorable terms for payback when we get the rebates, and then beyond that, it's dehumidification, some irrigation lines, and new fans. It's as simple as that. And so the capital cost beyond the lights is fairly minimal, less than $1 million, and we'll just phase it in over the installation period. We have a lot of vendor financing for equipment financiers and manufacturers that they're willing to work with us. They understand the efficacy of the retrofit, and so we don't anticipate needing to raise specifically for the retrofit at this time.
Mm-hmm. And obviously, increased capacity has got to go somewhere. Maybe explain where that extra capacity is expected to go.
Yeah, so I'll start with the chart on the bottom left here. So ultimately, right now we're 100% B2B on the Humble asset. So all of the flower is sold domestically to licensed producers, and then a pretty substantial portion of that flower is being then distributed internationally. And so while it's been a reliable sales channel for us, we sell all of our flower on a monthly basis. We are going to enter the CPG market for a couple primary reasons. Number one, we want to assure that we have the appropriate markets for our incremental flower production. But number two, we actually there's the opportunity to earn higher margins, contribution margin per unit of constrained resource with CPG. And so we're estimating that ultimately it'll be a 50% CPG, 50% B2B sales mix, and that it would result in the revenues you see here: low case, base case, high case. So this is our existing revenue run rate, and then here's the incremental revenue from Humble. And so the range is 53.5 to 65.5 million revenue. And so how we are going to enter the CPG market is obviously a critical question for us. And so that's where the Uncommon Cannabis Co-acquisition comes in. Of course, this isn't an acquisition of a huge LP or a long established brand, but it's a brand that we believe has significant potential. If you look at the right there, that's its sales velocity. So that's retail point of sale. That's not our revenue. That's the revenue at the retail stores. It's been ramping significantly. It has a very, very strong Quebec SKU, which will actually be our largest SKU as a company once we do the transfer. And so we believe in Uncommon, and we are going to work hard to ramp the volumes of Uncommon prior to Retrofit production coming online.
Mm-hmm. Why don't we talk about some of the other sort of products or brands that you've got? The Sluggers is probably the one that's the most interesting or recent to talk about. What can you tell us about Sluggers and any of the other products that you guys are out selling?
Yeah, so this is our brand portfolio today. This is before Uncommon. Of course, this is just our brands. So I'm not going to spend a lot of time here. I think most of the people on the call are probably familiar with our brands. But as I said before, Astrolab is fully solventless, ultra high-end kind of premium dabbable concentrates and traditional hash and things. And then Fruity Hootie is a blended solventless product, so we call it live rosin amplified. Royalty is hydrocarbon concentrates, which is in the same mold as Astrolab, but it's a different part of the market. It's hydrocarbon derived versus solventlessly derived. And then we get into our ultra high potency kind of products. And we're just really thrilled about its performance. So if you look at really over the last, I'll say probably 6 months, we've been conducting a very comprehensive commercial, I guess, refresh and kind of implementing a commercial strategy that we think is going to work for all of our brands. And the reason, if you look at this is again CPG retail point of sale sales. So this is the cash register at retail. So these aren't our revenue numbers, but really what we're trying to do here is just illustrate the trend. And so if you look at all of our brands, so our portfolio of brands plus our white label brands, you can see, the trend is over the last 2 years when we really started the business in terms of CPG, it's been trending up. But if you break it down a bit more, we have some problems and we have some great wins. And so some of the problem, mainly due to resource allocation and focusing, on status and some white label initiatives, you can see that the legacy brands is essentially Astrolab, Lamplighter, Fruity Hootie, Royalty. You can see that it's tailed off a bit. So it was late 2024 up to, call it the 12, 13 million retail point of sale run rate. And it's tailed off to about 8 million. And so that's where our commercial strategy is largely centered, is on reinvigorating those brands, getting those brands back ignited and trending in the right direction. But the positive, of course, is that we've significantly expanded our white label business. So this isn't just Sluggers. This is, several brands in here. Some of them that, we've never publicly disclosed, but you can see the ramp of revenue on white label has been significant. And we really like white label because generally we don't need to deploy the resources into sales and marketing. That's always generally paid for by the brand that we're white labeling for. And then in terms of an internal brand that we have allocated resources into and that's done incredibly well is, of course, Status. And so Status is our largest brand now, and the trend is steepening. I mean, it's gaining incredible traction, and the thing that really encourages us about Status is that it's currently it competes in 1 gram blunts, 5 by 0.5 or 5 by 0.25 gram infused pre-rolls. And then it does compete in 1 gram all-in-one vapes. But all the categories that competes in other than the all-in-one vapes are very, very, very small categories. And so there's a real significant opportunity with Status to extend those products into larger formats, such as so if you look at the infused pre-roll category as an example, 3 by 0.5 and 5 by 0.5 gram infused pre-rolls make up something like 80 to 90% of that market. We're not participating in that yet with Status. Consumers love the flavors. They love the brand. They love what it's all about. And so we're very encouraged on how things will look once we start to enter those larger product formats with Status. And then on the vape side, as I mentioned, we're in all-in-ones, 1 gram all-in-ones. We have our Bubble 1 gram all-in-one is just, it's gaining huge traction. But in the vape category, the 510 cartridge segment is much, much larger than all-in-ones. And we don't have 510s yet. So that's another extension that we're very excited about. And so overall, we're doing some rebrands of our legacy brands. So Lamplighter, I'll show an example of that in one of the next slides. But we're going to get those back going again, and we're doing some pretty fun things with the branding, and we're doing some shift in our thinking process and our commercial strategy to be longer term focused and more segmented in terms of who as a consumer each brand targets and how we meet the needs of those consumers. And so if you look at go down here. So this is the new Lamplighter, essentially, and I'd encourage you to check out the current Lamplighter, but really, Lamplighter worked for quite a while, but really the branding was focused on this kind of California cool vibe, and you're on the beach and you have your vape with you, but I mean, we don't have a lot of beaches in Canada, to be honest, and you can't take your vape with you to Mexico, and it just started to not resonate with us internally anymore, and we think the customer felt the same way. So we're reinvigorating Lamplighter into a more edgy, fun, ultra high potency, liquid diamond, flavored liquid diamond product company, where more focused on a demographic that really buys a lot of cannabis, which is generally the age of 20 to 30. And so that's an example of one of our rebrands that we're really excited about. We've received multiple new listings of these products and new flavors: strawberry strobe, limelight, and blue raz. So they'll be launching in Q1. We're really excited about those.
Let's take a step back a little bit and talk about what you're seeing as far as just industry trends. What's happening out there, within the sector, and then we can touch on sort of investor, let's call it investor trends right now that you might be seeing as well. What's happening inside the industries as a whole?
You mean at the corporate level or in the consumer product level?
Let's take a few different stabs at it. A year ago we were talking about consolidation, and international sales were a big thing. What's happening out there that you think maybe the general market like ourselves aren't really aware of?
Yeah, so I mean, I think consolidation is still very much required in the industry. There's just very few players that are capable of doing it. I mean, that's for multiple reasons, whether it be access to capital or, even set up as a team to conduct M&A and to integrate acquisitions properly. But of course, so I'll go to the humble slide again, just because it something that resonates with me personally is uh, Canopy just acquired Montreal Cannabis. And so the way that we view it is, the vast majority of successful licensed producers are underpinned by a significant cultivation asset. And Montreal, of course, was one of them. So if you look at our annual in the bottom right chart, this is our total cannabis production at Humble. So it's currently about 8 metric tons per year. And our base case post retrofit is about 16 metric tons, and high case 20, low case 13. And of course, that's, as we've mentioned before and disclosed, it's based on about 2 years of proof of concept data that we have on running the different setups within the pods, and that's based on our actual output of the retrofit setups. And so if you look at 16 metric tons a year, I mean, Montreal, I believe, is in the 18 to 19 or 18 to 20 metric ton range. And they sold to Canada. I mean, of course, I'm not comparing us to Montreal or proclaiming that we're going to be acquired for the same metrics, but they have the same, the slightly more production as us post retrofit. And they sold for 125 million plus debt, and the debt was about 50. So all told, they sold for 179 million enterprise value. And so you look at a group like Canopy, you look at a Canopy, Aurora. I mean, they've gone completely off balance sheet. So they were leveraging contract manufacturing and cultivation for the last few years. And the fact that, Canopy, I believe they have about 100 metric tons of demand per year, and they grew virtually none of it themselves. Aurora had about 80 metric tons per year, and they grew about 40 metric tons. So Canopy had about 100 metric ton deficit, and Aurora is at about a 40 metric ton annual deficit. And then now Canopy is acquiring infrastructure to cultivate again. And so to us, that's very interesting. I think that for us, it looks like an inflection point where it is possible where the large LPs may start to bring infrastructure on balance sheet and control their own supply, because they're viewing, I think in a lot of cases, supply as one of their primary business plan risks. Is where do we get stable, consistent inputs of flower to meet our demand?
Awesome. And then let's switch to investors. We've noticed that there's been a decline in investor interest in the cannabis space in general. Now, the MTL acquisition you mentioned sparked it up a bit. We every now and then we get some news out of the US that seems to spark the industry a little bit. But just generally, what's been the response? I know you're probably an outlier a little bit because of the attention that you got over the last year or two. But what's it been like speaking with investors over the last few months?
Yeah, I would say, generally speaking, the people that take the time to understand the story and get and dig into it and understand the management teams involved and kind of where each company sits, I think they're they're strong investors, and there's demand there from those investors. I think institutionally, I think it's still generally, well, not generally, I think it's just completely risk off institutionally. There's very little institutional interest in this space still. And it just comes down to results and continued results. I mean, obviously, we're in a phase now where, there's several strong LPs that are generating consistent cash flows and strong EBITDA. I think, as that's sustained, I think investor appetite will expand into institutional at some point. Of course, the States always plays into this. Of course, the rescheduling had really, it was just a trade more than anything. It should theoretically open up access to capital. We of course haven't seen that to this stage, but I would say it depends on the investor that you're talking about. If you're talking about, sophisticated retail investors, I think that there is appetite there. If you're talking about institutions, there isn't.
Yeah, no, fair. I can sort of relate to that for sure. Jeff, one thing that everybody has sort of been bringing up as far as hash is just cash flow. What are you able to say about your ability to generate cash, your current sort of financial position here as you build out? What do you feel that the investors need to know?
Yeah, so Q2. Oh, sorry. Q2, there is, we had just over $1 million of cash flow from operations, I believe. And then, of course, Q3, we had a bit of a decline in revenue, as you're all aware. And we were, pretty neutral cash flow from operations. And so in terms of our ability to generate cash flow, we feel that we're at kind of a baseline revenue level that supports generation of cash flow with growth. And so, through 2026, we're not looking at huge cash flows from operations in the first couple quarters, but certainly we do see the Humble Retrofit as a significant incremental boost to cash flow. And by then we should be strongly free cash flowing. And that's even even if we don't expand our CPG or retail revenue whatsoever, if we just hold that consistent, we believe that by the exit of 2026, we'll be significantly cash flow positive, in large part due to the Humble Retrofit. And also because, I'll go to another slide here. I kind of wanted to just remind everyone, kind of what we've been up to. I mean, we believe consolidation in the industry is required. So of course there's two components to this equation of cash flow. We need revenue, and we need a sound cost structure that supports not only profitability but revenue growth. And so if you look at us back before we started completing acquisitions, we were about 90 people at Massive Hash Factory. We added CanMart, it took us up to about 130 people. Added ANC, it took us up to about 230 people. And then Humble. And so these are the numbers just at basically the day that we did the acquisitions. Humble would be 319 if you added up all those employees. And we're at 175 now. So this is the power of consolidation and acquisition. So we have a baseline revenue level now where we know that we have, fairly neutral cash flows from operations. And we've significantly right-sized the business, not only to save the cash, which is about 7.8 million of payroll per year that we've been able to rationalize out of the system, but an infrastructure profile that will allow for very, very strong growth. And so, with the Humble Retrofit, our baseline revenue levels that we kind of have shaken out at, and we know what we have, so to speak. And then the cost profile that we've achieved through integration of those acquisitions, we think that we're pretty well positioned to drive cash flow going forward.
You've faced a lot of challenges over the last 6 or so months. Going forward, what do you think is your greatest challenge as you maneuver around all these projects?
Yeah, I think, just maintaining focus on obviously our commercial strategy. We have a lot of new listings coming. If you look at this slide, it's something like 91 new product listings over the next 3-4 months. There's a lot to be encouraged about from revenue growth, but then the humble retrofit really is, we're very sharply focused on the humble retrofit, executing that, on time, on budget. And from there, it's really, as we stated going back even, 9 months ago, 6 to 9 months ago, that the balance sheet strength was important to us. And so we've been chipping away, of course, at our balance sheet. Today, you saw we had $1 million of senior secured promissory notes converted to equity at 20 cents per unit. And so things like that, really helped the company because, that was a $1 million cash obligation in June, kind of right at the tail end of the retrofit, which, of course, that it's not advantageous to us to cut $1 million check at that time. And so, being able to equitize that prom note, having the faith that person, entity put into us, in exercising that and equitizing, makes a big difference to us. You look at our debt levels. I think post conversion of that prom note, we're at something like 7.9 million debt total. Right here. So we have the prom notes, $1.5 million left. These are paid off $100,000 per month. We have the convertible debentures, of course, which are interest only, paid quarterly, 11%. And then we have the small CanMark BTB. And so, you look at this back in February, March, we were something like 12 million. So we've made a lot of progress in strengthening the balance sheet, despite some of the challenges that we have faced, which, it's always challenging, but you have to just keep going. You have to be resilient, and you have to put a good business plan in place that's capable of delivering results and value to our shareholders. And that's why we're excited today, is because that's what we believe that we've done. And I believe that, we're very strongly positioned to achieve strong value for our shareholders going forward.
Mm-hmm. Jeff, so we talked about some of the challenges. Looking forward, obviously humble is a big deal for you guys. That's got to get you excited. But what, apart from humble, what else gets you excited about what 2026 brings?
I mean, I'm really excited about Status because, it's doing, I mean, don't quote me, but it's by far our biggest brand now. It's well over $1 million a month, and we're not even in large product categories. So I really believe that Status has the potential to be, a top 10 and even beyond that top 5 brand in large volume categories. So if we can get our core brands back, for example, Astrolab, it was number 1 in rosin. Now it's number 4. We think it should be higher than number 4. Right? We think that those brands have significant potential. We have an incredible marketing team in place now that's doing a lot of really, really exciting things on the branding side and on the commercialization side in general. We believe if we can get those brands back where they belong and just even back to prior levels, and then we fuel Status appropriately and target those large volume formats like 3x0.5 infused pre-rolls, 5x0.5 pre-rolls, 510s, that, there's an opportunity for really significant organic revenue growth in our portfolio right now.
Mm-hmm. Jeff, we got a lot of questions that have come in. Why don't we tackle some of the ones that come in from our audience here?
Absolutely.
Let me bring it up. And by the way, anybody else who has some questions, please use the chat function. We'll fire up the questions here. Okay, first question comes in from Paulo. He says, "Have you received interest in takeover offers from other players?" You've been doing the acquiring, but is anybody kind of come and kicked your tires?
And so we haven't had people kick our tires per se, but there's been, we feel like there's been more inbound calls in general commercially, and whether the ultimate intent of some of those conversations are M&A activity, we don't know. But we do, we are pretty encouraged by the Montreal acquisition and how that is a case study for LPs like us that are underpinned by a significant cultivation asset. And so would I be surprised if we started to have inbound calls on being acquired? I wouldn't be surprised at all. But of course, there's nothing definitive in the works at this time.
Yeah, fair enough. Okay, our resident cannabis expert, Mark, has some questions here. I'll start reading these off. He says, it seems like about 2/3 of Status's sales in recent months comes from infused pre-rolls. These are all flavorful liquid diamond infused pre-rolls. Can you talk about your positioning vis-a-vis General Admission, Jeter, and Claiborne? And how are you able to secure shelf space compared to these three big spenders with dominant market share?
Yeah, and no, that's a great question. And so we view Status as our version of General Admission, Jeter, Claiborne, etc. I believe though, the all-in-one, the 1 gram all-in-one vape is the biggest SKU in Status, but regardless, though that's the category and the consumer profile that we're targeting is the same consumer as those large volume brands. And really what it comes down to, Mark, and it's hard to believe this running a cannabis company even, but it really comes down to the product. 100% it's about the product. If you have a great product that resonates with consumers, has good flavor profiles, especially because all the large volume categories like infused pre-rolls in particular and vapes are all flavored liquid diamond products. So it's really about flavor profiles. And so if you can get flavors that resonate with consumers, you're off to the races. And so that's what we believe we have with Status. We have some incredible flavors like Lambert Kiwi, Bubble, Melanair. It's just great flavorful products that are ultra high potency. And we've positioned it to run with those products. Of course, they have existing shelf space. They're entrenched, very significantly. But even if you look at it, something like Jeter, which had the benefit of course, being a U.S. brand and had the U.S. marketing behind it. But I mean, it didn't exist on Canadian shelves a year and a half ago. And so it's taken significant share. And so we believe that Status can take significant share as well.
Awesome. Okay, second question from Mark. Lamplighter, Astrolab, and Fruity Hootie all offer fruity infused pre-rolls. It appears to have become the largest product category for Astrolab and Lamplighter. Can you talk about the positioning of these three brands as contrasted with Status as well as General Admission, Jeter, and Claiborne?
Yeah, and so that's one of in our commercial strategy, what we've really focused on is our intent was always that they are, differentiated brands and targeting different consumers. And I think that some of our brands have drifted to overlap and potentially cannibalize each other. But really, Astrolab is not about flavorful infused pre-rolls. Astrolab is about pure, potent, solventless or terpene-rich, solventless concentrates. And so all of Astrolab's pre-rolls are live rosin infused without any botanical terps or even cannabis terps added. It's just pure expression of the flower. So we take high quality flower and infuse it with live rosin. Very expensive to do that compared to our competitors, but unbelievable products. Fruity Hootie, as I mentioned before, is live rosin amplified. So they're live rosin infused pre-rolls, but we do infuse those with terps and we use some liquid diamonds in them as well. Basically to bring the price down a little bit on them compared to Astrolab, because not everybody is willing to pay for the best. People want the highest potency and the lowest price. That's what rules the day in this industry. But it is targeted at a different consumer, and that's one of the primary mandates of this commercial repositioning is getting Fruity Hootie into a specific target consumer. And then which is the other brand that you mentioned? Lamplighter. Yeah, and so Lamplighter. Let me bring this up here. Not sure what happened there. So, I mean, this is the new Lamplighter, right? So this is targeting, younger people, 20 to 30 years old that are in the nightlife, trying to fuel their evening basically, right? And so I think that this is going to be a fun brand. We'll see how it takes off. And then as it relates to status is literally all about flavor. It's all about those loud flavors, ultra high potency liquid diamonds, 97, 98% THC. And then of course a pretty fun brand and marketing aesthetic behind it. So that is one of our primary mandates here, Mark, is to make sure that we have different people targeted for each brand. And of course it takes a bit of time, but I think we have the people in place now and the strategy to make sure that happens as we go forward.
Mm-hmm. Can you talk about infused pre-roll gross margins at this brand and generally?
Yeah, so I mean, if you look at our CPG products in general, we're generally targeting around 25 to 40% margin. And so, that's pretty consistent across all of our brands. Ironically, after the accounting changes, of course, with Astrolab and our input cost of rosin dropped significantly. So our margins on some of those products now are significantly higher, even in the 60 or 70% range at times. We don't manufacture liquid diamonds internally right now. So, we procure those third party. There's a huge market available for it. There's an abundance of supply of liquid diamonds and those types of inputs. So, we're able to maintain strong margins on our non-solventless products as well. And of course, from a pre-rolling perspective, we have unbelievable pre-rolling capacity, unbelievable efficiency within our pre-rolling operations, within our infusion and our methods of infusion. We have a patent on liquid infusions that we hold that we haven't enforced yet. Of course, we may look at enforcing that patent at some point moving forward. But in terms of actually manufacturing pre-rolls, I think we're right up there with anyone in the industry in terms of our capabilities. And if you look at Jointcraft, which Jointcraft came in and really competed hard on price, and they do a great job as well, but they just filed a notice of intention with their creditors. And so we don't know whether that will create opportunity for us, but certainly we're keeping an eye on it.
Mm-hmm. Jeff, does it make sense to have so many IPR brands?
Absolutely, it does. Yeah, I mean, it's a huge market, absolutely gigantic market, and there's different consumer profiles. I mean, basically that question can be answered by: is there room for tribal? Is there room for nugs? Is there room for general admission? Right? I mean, there's wildly different product categories within infused pre-rolls. There's wildly different product formats within there. And so there's all kinds of market there for multiple different brands, as long as you're differentiated and serving different profiles of consumers.
Next question from Mark is, he says, I'm curious how you describe Status's competitive positioning in vapes, ? How does the brand differentiate itself?
It's flavors. It's great flavors and a fun brand. It's as simple as that, right? Like you put multiple products in market and they all have the same opportunity to succeed. And then some of them do extremely well. And that's about the flavor. Like you look at general admission, Tigerberry. It's still an incredibly successful product. You look at Liquid Imagination products from Back 40. There's products that consumers fall in love with. And Status, we have some of those flavors that consumers are falling in love with.
Awesome. Mark says, is it correct that most of Uncommon's most recent sales results have come primarily from the 3.5 gram rose gold pave in Quebec? And if not, please explain the assortment.
Yeah, no, probably. So about 70% of Uncommon's revenue is from Quebec and from that one SKU. It has one SKU in Quebec, and it's the rose gold pave. And so it's done incredibly well. And that product is not across Canada. Uncommon as a whole isn't in Ontario because the market was too big to service. We couldn't, Uncommon couldn't, basically, they didn't have the balance sheet to procure the flower as a branding house to service Ontario. So they were in Ontario and then basically left Ontario. So there's huge opportunity with Uncommon in terms of accessing different markets with rose gold pave and other SKUs. And of course, by bringing it in house and fueling it with our humble asset.
Second part of the question is, please discuss the prospects of additional SKUs in Quebec to satisfy the demand for incremental flower.
Yeah, so of course, it's something it's an ongoing process, right? In terms of adding incremental SKUs, doing new listings, taking listings that don't perform off. You continually have to launch new products and right size and ensure that you have good velocity in your portfolio. And so Quebec is a huge opportunity for us in terms of.
I'm recording this, so if you want to talk.
Brad, your mic is live, Brad. There we go. We're fixed, Jeff. Go on.
Yeah, and so we view it as an opportunity, absolutely, to pursue additional listings in Quebec, but also in Ontario. Ontario, Alberta, Manitoba, Saskatchewan. We think that the brand has some legs, and we're excited to expand it.
Are international sales another source of that future demand? And if so, discuss the strategy there.
Yeah, so in broad strokes, our strategy is to do about 50% CPG, 25% domestic B2B, and 25% international B2B. We service the international B2B market right now, predominantly through domestic LPs that then sell it internationally, but also, we do sell some into Portugal. And so it's a very strong channel. Of course, Portugal was pretty flooded with product for quite a while. And we saw demand in the system decrease a little bit because of that. I think that'll rectify itself going forward in terms of supply demand, and that's one of the reasons why we do want to pursue CPG, though, because we know the Canadian market, we know the scope of the Canadian market, we know the consumers of the Canadian market, we have all the manufacturing capability, marketing, branding capability to pursue that market, and we understand the price ranges that it's operated in within the last 4 years. So it's a stable market. It's a competitive market, highly competitive market, and it's not an easy market. But with the Canadian CPG market, you know what you have. You know what you have to do to succeed, and you can, you have your roadmap to success. And it's not subject to more macro level issues like what happened with Portugal and of course Germany a few months ago, and regulatory changes and things like that. So we will pursue international B2B, of course. There's strong margins there. In the ranking of our margins, it's number 1 CPG, number 2 international B2B, number 3 domestic B2B. We're also in discussions with several groups about long-term contract cultivation scenarios out of Humble. And so we're going to balance that with CPG.
Mm-hmm. Jeff, Mark says, will you be growing just this genetic? Please discuss your genetic strategy for the Humble Grow facility now and into the future.
Yeah, no, we have, right now we're growing 6 different cultivars at Humble. We're continually pheno hunting. We have about 4 new genetics that we're really excited about with, widely different terpene profiles, all very, very high potency, coming in at the 28 to 30, kind of 31% THC range, which is obviously demanded by the market. And so, pheno hunting is a never-ending game. You have to continually pheno hunt and find the cultivars that are hitters, not just in terms of cultivation yield and potency and IPM resistance, things like that. But genetics that hit with the market and taste good and that resonate with people. So that's an ongoing project, and we have a great team at Humble. Bobby Baines is our master cultivator there, long time cultivator, and we're really excited I think that's one of the reasons why Uncommon is a good fit, is because it's focused very much on craft flower. Humble being an indoor cultivation facility, not a hybrid greenhouse, it produces very high quality flower, and with the pheno hunts that we've been conducting over the last 6-12 months, and the genetic pipeline that we have, we're really excited that it's a great fit with Uncommon and their craft approach.
Mm-hmm. Jeff, Mark asks, what is going on with sluggers? I see 2 SKUs so far with very limited distribution that appears to have stalled out.
Yeah, so it went well initially. There was a lot of groups clamoring to kind of have preferential launch rights and things like that. But there was an issue with getting tins, of all things, packaging. So that's being rectified, and basically it'll get ramping again here, hopefully in the next couple months.
Mm-hmm. Gotcha. Okay, let's see. A few more questions here. Greg says, can you give any color on increasing inventory numbers?
So I think if I recall, Q3 was about 22 million, and we had, what was it at year end? 16 million maybe. So the biggest component of that would have been Humble. So we didn't have Humble before, so you had incremental Humble inventory. I can say that our capitalized overheads and things are about the same level as they were at year end last year in our audited financials, and so I would just say it's likely things like Status, having incremental inventory on hand for Status, for our other brands. And yeah, but it's not due to things like overheads or anything like that.
Mm-hmm. I should have finished reading the whole question, because you may have answered some, but maybe not. Is the inventory growth primarily related to finished goods, work in progress, or raw materials? And can you comment on inventory turns and how you expect them to trend over the next few quarters?
Yeah, so I would say it's balanced between finished goods and raw goods. Even non-cannabis inputs like all-in-one vapes and things like that are very expensive. So I'd say it's kind of a mix of the different categories of inventory. And what was the second question, Paul?
Can you comment on inventory turns and how you expect them to trend over the next few quarters?
Yeah, I would expect inventory to remain pretty flat, and of course the turns depends on revenue, right? So if we can expand our revenue, then our turns of inventory would be faster, I guess is the primary thing I can say.
Mm. And what is your target inventory level relative to revenues? Do you have that set?
Yeah, so I think even our revenue now is fairly in line with competitors. You look at groups like Decibel and a lot of these groups are something like 40 million revenue. But inventory, something around 50% of revenue is pretty typical. And you need the revenue, of course, to expand revenue. So it's always a balancing act if you're in a period of growth. It's pretty easy when you're banging out 150 million revenue for the last 3 years, and you know exactly what your market is and what inventory you need to procure. But if you want to grow and expand revenue, then some at times you have to be a little bit more liberal with your inventory and make sure that you have it there so it can fuel growth.
Yeah, no, fair enough. Okay, Flabertus asks, how much capital do you estimate to raise in 2026 through equity financings? Are you considering doing any equity financings?
Yeah, that I can't speak to planned financings or things like that. That would be inappropriate.
Mm-hmm. Do you, let's ask it sort of in a different way. Do you expect to see more acquisition opportunities over the next 12 months? Is that something you're going to go, look for? Is that something that continues to present themselves? And if so, how interested are you in doing further acquisitions?
Yeah, and so we consistently look at basically every company in the country, and it's just a matter of comparing them against the other alternatives for any capital that you may have, or in the context of the access to capital that you have, and whether it's accretive on a per share basis. At this level, there's not a lot of acquisitions that are going to be accretive on a per share basis. And while some strategic acquisitions would make sense if they're not accretive per share, if they satisfy, large strategic objectives or things like that, then sure, maybe we'll look. But at this point, we don't see any of those, and we have our finger on the pulse of the landscape in M&A in Canada. We have a pipeline of potential acquisition opportunities at hand. But I think that we need to drive some growth and value here with the Humble Retrofit and get our brands back on track that have faltered and fuel status. And I think at that time we'll be in a much different place with our cost of capital, and things will become more creative again. And so, in the meantime, I think we have a pretty meaty bone here to execute and achieve on with our base business plan. And we'll continue to understand the market and keep our finger on the pulse. But pulling the trigger at 16 cents isn't something that we're looking to do.
Mm-hmm. This is probably more of a comment than a question, but MB says, I'd be interested in seeing a clearer split between business segments in reporting. The manufacturing segment versus bulk segment versus CPG segment. I would assume that they are separated for internal reporting purposes. Would be super helpful for them to be presented this way. So clearly not a question, just a comment.
No, it's a great comment. We'll take that away and move towards that.
Yeah, perfect.
Sorry, you're just breaking
Sean asks, how is the new marketing team working? I'll try again. Sean says, how is the new marketing team working? Any surprising challenges or wins?
Oh, no, the new marketing and sales team are making fantastic contributions. The sales team is really adding to things, even like product development and making sure that we're addressing where the puck's going, not where it was. And our marketing team is just, incredible group of people. And I'm really excited to be able to kind of roll out some of our updates over the next few months here on our, on Astrolab and Fruity Hootie and Lamplighter. And then you'll be able to see kind of the fruits of their labor. But great people, incredibly talented, and I think they're going to add a lot of value.
Mm-hmm. Mark just wanted to say, Paul, thanks for asking my questions, and Jeff, thanks for the very helpful, thorough replies. Okay, next question comes in from Paul Kozak. He says, would you consider changing convertible debenture price to the same terms as announced today?
Everything is always on the table. Clearly balance sheet strength is important, but then we have to weigh that against dilution. So, it's something that, of course, we've thought about and considered over time. And I think if we could do it in a way that makes sense for everyone, and we're moving forward with an appropriate capital structure, not just in terms of debt, but in terms of our share structure, then I think that it's something that we would look at.
Mm-hmm. Great. Okay, Russell asks, will the Uncommon acquisition open the doors for your other products into Quebec? And if so, do you have a timeline, any projections on what it could eventually contribute to revenues?
So, Uncommon itself, if you look at our business plan at a full run rate with Humble, the base case is adding about, 22.5 million revenue. And of that, you might as well call about, 5 or 6 of it is B2B and international and domestic. So the delta of 15 million of revenue has to come from CPG. So that's kind of the scope of the CPG dried flower and regular pre-roll business. Of course, the regular pre-roll business is a huge market as well. And then in terms of Uncommon, I don't see that Uncommon will open up Quebec. Actually, one of the positive things about Quebec is that Olin Vanderleed, and he's on our board of directors, he's been helping us a lot commercially and with our commercial strategy. He's done an absolutely incredible job, and he has a long-standing history in Quebec and working with Quebec. He was the chief commercial officer of Greentone Enterprises, which is a Quebec-based licensed producer. And so Quebec as a whole is an important market for us to gain some share, in. And I believe that we'll be able to do that, kind of with or without Uncommon, so to speak.
Mm-hmm. Gotcha. Okay, what do we got here? Russell says, would you consider merging with anyone, or are you only acquisition motivated?
I mean, I think it all just always comes down to the deal at hand. Of course, we would look at everything, whether it would make sense or not. I mean, it would have to exceed what we believe we can achieve as a business over the next year, call it, right? And like if someone came in and made an offer, I think it would have to be at a pretty substantial premium to really get us to stop and think about it. And that's just because, we really believe in the business plan we have in front of us and the value that it can create. We think that exit 2026, we're capable of, substantial EBITDA levels and we think that we're fundamentally undervalued in the market, pro forma. And so we think that for our shareholders, executing this plan is very beneficial and it would take a lot to exceed that in our view.
Mm-hmm. So Jeff, the notes I took down here is, and correct me if I'm wrong. So currently you've got a run rate of about 36 million in revenue. Is that about right?
Yeah. That was the Q3 annualized revenue level.
Yeah. And with the Humble facility fully up and running, you expect to see about a $58.5 million, call it pro forma run rate. That sounds about right?
Yeah, that's that current. Like if you take our current base business at 36 million without any growth whatsoever, then we anticipate that revenue level. Yes, 58.5.
So it clearly that's $22.5 million delta there. You've got the lights more or less taken care of. What incremental capex do you have to sort of get to be able to get that 22.5 million?
Yeah, so the remaining items such as dehumidification, irrigation lines. I mean, largely we have vendor financing for those items, and so we don't need to access any incremental capital to complete the retrofit. And frankly, we don't even need those items. We could do the retrofit without. So we're in the position where we can play it by ear and we can add those components over time. All of the yield increase comes from the lights. So, we can achieve the kind of yield profiles and very, very strong quality with just doing a light retrofit. Part of the retrofit contemplated purchasing rolling racks for the middle of each pod, whereas right now the tables are on each wall on the sides. So instead of acquiring those tables, which was about 550,000, we're going to use the existing tables and just move them to the middle of the pod. So basically just doing this on a shoestring and sharpening the pencil and taking a second fresh look at it over the last 3-6 months saved us a lot of expenditure. And so our plan is to do this on a shoestring to achieve the increased production and revenue and to first of all fund things like dehumidification with vendor financing and or cash flow either pre or post retrofit.
Jeff, no, we just switch it around a little bit. We're watching the business now. What do you think are the greatest catalysts that we should be paying attention to really determine that everything's coming along properly?
Yeah, I mean, and that's it's a great question because as an investor myself, catalysts. I love catalysts. I love that instant gratification. I love seeing news releases. I love seeing all that, and it's exciting. But we need to be steadfastly focused on executing this plan in front of us. This isn't a flashy business plan. This is a solid, achievable business plan that over the 6 to 12 month time period can add significant value. In terms of near term catalysts, I would say things like the execution of our revised commercial strategy, our rebranding initiatives, our launch of products into larger formats and status. Things like that are kind of the nearer term focus, and that could be that could generate some catalysts. But it may not be like it was in 2024 for us, where every 3 to 4 months we're announcing an acquisition and kind of a very catalyst heavy business plan. That business plan served us very, very well at that time. It expanded our revenue from 7 million to currently 36 million very quickly. It provided the infrastructure we need to use that as a baseline and expand revenue from there. But in our current deck of cards or hand of cards that we have in front of us today, it requires a little bit less of a catalyst-driven approach and more a little bit less of a transaction-based approach and a little bit more of a execution and focus and achieving things over the 6 to 12 months approach.
Mm-hmm. Jeff, you're generating $58.5 million in revenue. What are you hoping to see as far as EBITDA on that revenue?
So post retrofit, the base case is 58.5, and on the base case with current EBITDA levels of the Q3 annualized 4.2 million per year. So we're about 7.5 million year to date EBITDA as of Q3. But if we just annualize Q3 because it's lower to be conservative, with the humble retrofit, pro forma is 14.2 million run rate on the base case, and then it increases from there. So the range of EBITDA is basically 10.7 to 18.7 million.
Right. Gotcha.
So if we get more towards the 20 metric ton volumes and we monetize it for 50% CPG, 25% domestic, 25% international B2B, then we should be closer to the 20 million EBITDA level or 18.7. So
Gotcha.
It's a torquey investment.
Yeah, for sure. Listen, Jeff, it's always great to catch up. This has been extremely helpful. I had to write the word down scrappy on my piece of paper here because it seems like every time somebody thinks you're down on the mat, you seem to get back up. So congratulations for that. Obviously looking forward to success on the execution of the business plan. Last sort of word to you. What's the key message? What do you want to make sure everybody walks away with today?
I mean, ultimately, it's the word scrappy, I think, is reasonable, and it's just because our team, our group of people that we have here are committed. We're grinders, right? We love the expression "grinders with hands," like Joe McGinley. That's what you have with our team. We're in the trenches. We're doing everything we can to succeed. We're heavily invested. We have a lot of skin in the game, and that really does matter to us. And then, beyond our team, it takes a town to build a company. It takes supportive shareholders. It takes, external stakeholders. It takes a lot of different groups of people that believe in you and what you're doing. And so we're very, very grateful for, of course, small cap and the entire small cap community. One thing that we can say as kind of a key message is that, with your continued support, that we thank you for already. I mean, we, in the past, but with your continued support, you have a team here that's going to work endlessly to create value for you and do everything we can to execute properly and then have a call next year and, look back and I'm pretty excited to see how things have shaped up and what we've been able to accomplish.
Mm-hmm. Fantastic, Jeff. Thank you so much. We've been speaking with Jeff Swainson, CEO of Simply Solventless Concentrates. As everybody knows, symbol is HASH on the Venture Exchange. Jeff, keep us posted and look forward to the next time we can catch up.
Will do. Thanks so much for having me, Paul. Thanks, Trevor, and thanks everyone on the call.
Yes, thank you so much, and bye for now.
Bye.